Okay, everyone, we'll start off this broadcast for the month of January. Getting this out a couple days late. I apologize, but we'll kind of get rolling with it. As you can probably imagine, I've had a lot of calls and conversations with people, which is one of the reasons this has been delayed because the markets are really acting up so far in 2016. It's been a lot of fun. Just to put things in perspective, though, from the all-time highs, we're only down about 10% if you look at the big index, such as the S&P 500. So it's right now, it's really just a normal correction. The big question is, where is it heading from here? Is it going to be a much bigger downturn, or is it going to be onwards and upwards from this point forward? And as you can imagine, it's probably impossible to tell exactly what's going to happen. So, what I thought I'd do today is kind of take a look a little bit at both the bullish case and the bearish case for the stock market in 2016. Now, 2015 was certainly a year to forget. It wasn't a horrible year, but you had most asset classes were down. Nothing like a 2008 kind of down, not even like a '01 through '03 down, but down nonetheless. The U.S. stock market, large cap S&P 500 finished up, I think, a little over 1%. The bond market was fractionally up. Small caps were down. The international was down. Commodities continued the slaughter that they've been realizing the past couple of years. So, things overall weren't very good in 2015. So, how about 2016? Well, a lot of people, when you talk about kind of the bullish case for stocks, you sort of look at past years where the market has kind of stayed pretty close to where it began the year, plus or minus 5%. Going back, you can kind of see a few years going as far back as 1981. And for the most part, when the market is kind of flat, the ensuing year tends to be a pretty good year. The sole exception to this was 2007, when in 2007 the market was up about 5.5%, and then the next year it really just plummeted. But everything else outside of that was pretty much up. 81, 87, 90, 94, '05, and then 2011. In fact, the average return, if you take all of these years together, after the flat year, the ensuing return was an average of 14.19%. So I think most people right now would love to get 14.19% this year, especially considering how the market has started off. There's other things that you can look to that kind of help the bullish case. One of them, I think, is low inflation. Now, if you listen to what the Federal Reserve wants, they always want to have a 2% inflation rate. And this chart kind of shows you we're below that right now. We're not technically in a deflationary environment, but we're below the 2% Fed target. I think that's good for most people. When you look at the vast majority of Americans, they don't have a whole lot in savings. They're kind of living paycheck to paycheck. And then if you look at retirees, inflation is just an absolute killer for them. So really, if we could keep inflation between 0 and 1%, for the most part, I think that's pretty bullish for the economy. I think people won't have to cut back their spending as much if we have very muted inflation. Of course, another thing that a lot of folks are pointing to is the employment picture is certainly much better than it was, say, 5 years ago. We're back below 6% unemployment rate. Now, a lot of people claim, hey, that's because there's more people doing part-time jobs and the numbers kind of skewed. Certainly if you dig underneath the numbers, there's probably a little bit more of a bearish case to be made for the unemployment rate. But you have to look at this and say, hey, it certainly is a positive trend. There are more jobs out there for people. Maybe they're not paying as much as usually we'd like to see, and maybe people are having to work two jobs, but I'd rather have to kind of struggle and have two jobs than have no jobs. So that kind of gives a little bit more wind to the bullish case. And then the other thing, this is kind of an interesting graph. I don't know if you'll remember, 2011 was the last kind of sideways market. And if you look at 2015, boy, it's almost a mere reflection of what happened in 2011. Essentially, things were kind of sideways until the summer. We had a drawdown in the summer. Things kind of picked up through the fall. And then from October, November until the end of the year, things were pretty much flat. Same exact thing. And then if you remember the first graph, 2011 saw a 14% return on the ensuing year for the stock market. So 2012 was up about 15%. And then, of course, 2013, it was up 30%. So, maybe what we saw here was just the market taking a breather, consolidating its support for a future run up. Certainly the case could be made for that. Now, the bearish case can be made as well. And I think, they always say the bearish case is much easier to make than the bullish case. So you have to take that with a grain of salt. But I think when you really start to look at things, I think the economy is kind of slowing, not just here, but definitely worldwide. One thing I like to look at is the Baltic Dry Index. And what this tells us essentially is, what are these shipping companies charging? What kind of pricing demand do they have for shipping goods and, worldwide? Now, really, even since '09, the Baltic Dry Index has never had a solid recovery. A little bit of a recovery, but shipping companies have never really had that big of a command. Part of that could be they were adding a lot of vessels in the mid 2000s, and so there's still some excess capacity. So it isn't all driven by the fact that less things are being shipped, but this chart is just not very good. We're hitting lows we haven't seen since the 1980s. So that's, typically I think that kind of could tell people, hey, we're shipping less products. Not a good sign for the world economy. The other thing, and this kind of comes back to why shipping companies don't have as much business, but the commodities market has been just slammed here the past couple of years. And it isn't, oil gets the headlines because you see it when you go to the pump, but it isn't just oil. It's really most commodities. I should say most manufacturing commodities. So when you look at precious metals and industrial metals, those have been getting just waylaid the past few years. And again, that could be an argument that the world economy is slowing, the demand for manufacturing commodities is going down. But overall, I think that you have to look at this and say that there's certainly something to be seen from what's happening with the commodities complex. This chart here shows you what the commodity index versus the forward earnings per share estimates for the S&P 500. And while it's certainly not a perfect correlation, commodities typically tend to lead what happens with earnings per share for the S&P 500 companies. And as you can see, this was really about mid-year in 2015, so it's a little bit dated. But for the most part, commodities have been heading down, and that probably doesn't bode well for the earnings per share of the S&P 500 companies. So if earnings go down, of course, the stock market is nothing more than a barometer of future earnings. So that might not be a very good thing. The other big thing, and again, this is kind of tied to commodities, emerging markets. And when we say emerging markets, we're talking countries like China, India, Russia, Eastern Europe, South America. They're very much tied to commodities. So a lot of the problems that they're facing right now are commodity structured. But the fact that they're having issues could end up seeping into the general economy here in the US. This is just showing you kind of what's been happening to the emerging market currencies relative to the dollar. So it has been a steady decline for emerging markets, and that makes it very difficult for them because most of their debt, a lot of their bonds are tied to the US dollar. So if their currency is losing value relative to the US dollar, it makes it much more difficult for them to pay their debt. And this chart here shows the Morgan Stanley Emerging Market Domestic Debt Fund. So you can see these things are starting to take a hit. People are selling emerging market debt. That's not a good sign. And this could have a big impact on us. not necessarily for us exporting. It could really be a boom to us in the fact that we're importing products that are probably going to be even cheaper for us. But where it could have a big impact is a lot of the banks have been loaning money to these emerging market countries. So if these countries end up having an issue trying to repay their debts, just like we had with housing back in '08, we could see a crisis here because we're talking sizable amounts of debt that is owed to banks from these emerging market economies. So I think that this could have a problem and could seep into our economy. And speaking of debt, we're starting to see that a little bit with the corporate debt dynamics. So a lot of companies have been taking out extra debt and buying back their shares in order to provide a boost to their earnings per share. It keeps their stock price up. But you can kind of see here, the blue line is your net debt for corporations, and the red line is the earnings before interest, taxes, depreciation, and amortization. Essentially, you could just call it earnings. For the most part, debt and earnings are pretty tightly correlated. You really can't get too far up on the debt ladder without starting to impact the earnings. So those have historically sort of stayed the same. Recent years, past 2.5 years, we've had a deviation where the debt has been increasing exponentially relative to the earnings. So that's not a very good thing to see. The other bad thing about this is if revenues start to drop, meaning earnings drop, these companies now have a higher debt load that they're still going to have to pay. The debt doesn't go away. Earnings can go away, debt doesn't. So this could be an impact going forward. And of course, I've been beating this drum for a couple years and talking about valuation of the stock market. It's very expensive historically. And valuation doesn't tell you anything about what the market's going to do over the next month, quarter, year, even 2 or 3 years. But it does give you a pretty good idea over the intermediate term, meaning 5 to 10 years, of what your future returns are going to be. And the one that I like the most is the price to earnings on a 10-year scale. It's been called the CAPE, cyclically adjusted price to earnings, developed by Robert Shiller. He won the Nobel Prize for his work in this arena. But what Shiller was able to show that the higher your price to earnings over a 10-year period is, the lower your returns going to be going forward. And right now, what Bob Shiller is suggesting is the US stock market is only poised to provide about a 2.8% annualized return over the next 10 years. So that's not very good. And this chart shows that we are at a level right now that's only been surpassed a couple times, 1929, 2000, and the 2007 peak. So I'm not trying to imply there's going to be a collapse of stock prices. But what this chart does kind of tell us is that future returns will probably be muted. Finally, stocks above their 200-day moving average. This has been dropping steadily. This is a bit dated. It's really from September of 2015, but there's fewer and fewer stocks that are above their 200-day moving average. This means that the US stock market has been carried by fewer and fewer companies. So if you pulled out the top 15 companies in the S&P 500, and this is going to be kind of your sort of your hot stocks like Netflix, Amazon, Apple. If you pulled those out, the S&P 500 right now would actually last year would have been down, I think, about 8%. And right now, if you equally weighted the S&P 500, so if you took all the companies in S&P 500, which is a market capitalization weighted return, and you just equally weighted each stock, that index would be down about 20% from its high, not the 10% that we're at right now. So this is a good sign because what you want in a bull market is you have more. If you have a bull market with lots of companies leading the way, that's very bullish. That's very good. If you have only a handful of companies leading the charge, it puts a lot more pressure on those companies. If they have a falter at all, then everything tends to fall apart. So again, I try to keep these to very short, 15 minutes or less. I didn't really give you an idea of what I thought was going to happen. I'm not really all that bullish, to be honest with you. You might kind of get that from my indentation, my voice tones and everything like that. But anyway, we'll see. Nobody knows for sure what's going to happen. The key is to have your system in place and stick with it. If you do want more information, I do recommend you check out our website, picketfencefinancial.com/education. You can sign up for my monthly newsletter. I do not spam you. It comes out once a month. I do not sell your email address. You can always check us out on our Facebook page. And also, if you go to YouTube and click on Kirk Kinder, you can see all of our webinars that are happening. So I appreciate your attention. And if you have any questions, please don't hesitate to ask me.